Thank you for joining us for another episode of The Money Puzzle with Eric Douglas and Aaron McAndrew, a production of Family Wealth Planning Partners. Today, the topic that we have in store is the 4% rule, fact or fiction. The 4% rule has been around. I think it started in the 80s, and I forgot specifically the individual's name who came up with it, but it was basically an economist who popularized the theory or the idea of the 4% rule. 4% rule meaning that you need to be able to save enough money to hit a certain retirement number. Your retirement number was the amount of money that you needed to retire on, where you could generate 4% returns and live off of the income that a 4% return could generate. Meaning that the amount of income that you needed to be a multiple of 4% of whatever the total number of assets that you had to have saved up in order for you to retire. I think we're going to talk a lot about that rule today and our philosophy on it, but do you have anything to add on what the 4% rule is?
Well, I'm just going to give an example real quick so we can kind of put a scenario out there that we can kind of talk to.
Mm-hmm.
So, for example, if you saved, whether it's in your 401k, all of your accounts, whatever it is, if you had $1 million saved up by the time you were ready to retire, the 4% rule basically states that you're going to get 4% you're going to take distributions at 4% on that $1 million. And what your goal is to at least earn that 4% that you're taking the distribution off to sustain that lifestyle. We go back and forth and talk about this all the time. You worked your entire life to save $1 million so you can get a $40,000 income in retirement. $40,000 is, just above the poverty line depending on where you live.
Well, that's ultimately the idea, absolutely. So you're looking at, a $40,000 income, or basically that $1 million is supposed to generate a 4% return every single year, and you're living off of the income that is produced on that $1 million. And in theory, what's happening is you're always leaving that $1 million alone. You never touch the $1 million, you're only living off of the income. So a couple of things happen. One, that doesn't really give leeway to, if things go bad in a year, we're sitting in 2023 today, but if 2022 happens when it's an all systems failure in the market,
and it will
happen again, absolutely. Yeah. These things happen in cycles, right? And you're going to get all systems failure types of years at least once a decade. That's kind of the way, when you look at historically speaking, that's kind of the way that these years pop up. The 4% rule is only going to generate $40,000, but if you lose more than 4%, you have to adjust your spending levels. Okay, so if you're adjusting your spending levels down, inflation has been up over the last year, over 10%. At one point, it's down to 5%. We've talked about this before. How can you adjust your spending down? In some years, that's not going to be possible based on inflation. So now you're being forced to eat into your principal, and you're having to severely cut your lifestyle, which is one thing you never want to do in retirement, right?
Yeah, in a year like last year where the market's S&P 500's down over 20%, NASDAQ's down over 35% last year. Years like last year happen and you've got $1 million portfolio and you're invested somewhere, pretend it's a 15% down year for you. Still, that's $150,000 that your portfolio just lost in 1 year. And by the way, that doesn't even include your 4% distribution on top of that. So what happens there is, you're still having to take it, or maybe you're not taking a 4%. Like you said, you're cutting your spending as little as you can. So now you're not enjoying your year in retirement at all. You're eating ramen noodles like you're in college again, and you're crackers and whatever you can. You're not eating out. You're not doing that, and you're living in retirement basically hiding because your accounts are down $150,000, and I can't draw my $40,000 income off of that.
And now you're resetting that 4% off of $850,000 instead of $1 million, right?
And then the other thing is the argument to that you hear is, well, the markets are going to come back, and they will. But how much do they have to come back just to get you back to it's not the 15% you were down. It's more than that. They're going to have to come back significantly more than 15%. And we can go back to what's going on right now. Last year was a down year in the market, down, like I said, over 20% on the S&P. The NASDAQ was down 35 or so. Look at the NASDAQ now. We'll just take that in consideration because that thing has roared this year. It's It's come back a lot, but we're still not. It's up 35% or 34% year to date right now, which it was down 35% last year. We're not at 1%. We're not close to the highs. We're not close to its highs yet. I mean, it's come back significantly, but it's not close to the highs. So that just shows how much more it has to come back just to get you back to that point. And that's without you taking any additional income off of that.
As a general rule of thumb, you need double the return to get back to even. So if you lose 10%, you need a 20% return in the market to get back to even. The math isn't 100% correct that way, but directionally speaking, that's about where the numbers lie. So if you have a 15% loss, you need a 30% return, 20% loss, 40% return. And so that's one, difficult to expect, especially once again, if we're talking about a retirement income plan where you're taking distributions from the account at the same time that the accounts are dwindling. It's really tough to maintain that 4% rule. Because the idea, once again, the whole idea of the 4% rule is you never go below that principal. You always maintain that same account balance, that same amount of principal, and you're living off of the income.
Yep.
And it's interesting because the issues that I had with the 4% rule a decade ago are probably different than the issues that I have with it today. Because the issues that I had specifically with it a decade ago was you couldn't invest in conservative bond portfolios because you couldn't get a 4% yield in bonds or fixed income anywhere. Really low interest rates are great when you want to go refinance your mortgage. They're horrible when you're trying to get income or get yield from your fixed income investments. So bonds were only paying 2-3%. You couldn't even get that 4% to sustain that 4% rule strictly from a bond portfolio, which in theory, ideally, that's what you want to be looking for. You want to only draw that 4% from conservative investments. You couldn't do that in the last decade. Now, this decade, we have such high market volatility where it's tough to expect a 4% rule coming from stocks. Now, you can get that more in fixed income instruments. The problem that we have today with fixed income investments or bonds specifically is they are tied directly. The interest rates on bonds are tied directly to the Federal Reserve policy. You hate to say that the value of your fixed income investments is tied intrinsically to the government, but this is the environment that we live in. We work with what we've got. When you have a Federal Reserve that is making its monetary policy, in order to fight inflation, they're just spiking up interest rates as fast as they possibly can. What happened to bonds last year? Bonds fell through the floor.
Right.
The aggregate bond index was down 15%. High yield bonds were down more than that. Treasuries were a nightmare.
Yep.
It was historically the worst year ever for a bond portfolio. A 60-40 portfolio, that was the worst year on record for a moderate 60-40 portfolio. That's the bedrock.
It was 40 years since we've seen any type of drop like that in the bond market. It's been a little over 40 years.
Yeah, but what happened was we have an economic system that unfortunately is so directly tied to economic policy in Washington, D.C. that if you're relying on your income from your bonds, here's the problem. We could have a Federal Reserve that decides to change interest rate policy, and they suddenly start to lower interest rates. That's going to wreak havoc on your bonds because they're directly tied to those interest rates. We don't have a hands-off Federal Reserve anymore like we used to. The Federal Reserve did not used to set economic or monetary policy. They do now. That was basically established in 2008 after we had a market crash in 2008 where everybody said do something and, well, they did something. And they took on greater control of the monetary policy. And you're seeing it happen even more and more to a greater degree every single year, which is why it's becoming intrinsically tougher to be able to rely on the consistency of what's supposed to be the bedrock or the foundation of a retirement income plan, which is a bond portfolio. You can't rely on that consistency anymore.
The other fallacy here, another fallacy, because there's not just two or three, is when you factor in inflation. What's happened over the last year, 18 months or so? Inflation. Let's go back to the first example. The $1 million, I'm going to take 4% off that $1 million. Well, when inflation hits 9%, and that's just statistics, really like 20-something%, probably maybe even higher than that in some of ours, at 100% on some of the things we buy. I mean, gasoline double priced, or at least doubled. In some cities, it was more than that. But we're all paying that. Well, let's go back to your fixed 4% rule. On my $1 million, I'm going to take 4% out. That's $40,000. Now, all of a sudden, I buy less. So what happens when you
significantly less?
Significantly less. Now, what happens when you're in retirement? You can only take 4% out. That 4% may turn to 8%, 9%, 10%. Now I'm drawing 10% down on an account that, by the way, we had high inflation last year. We also had negative markets. Bond market was down 15+%. Stock markets were down 20+%. And we had double-digit, almost double-digit inflation numbers. That's not a good recipe for taking 4% off of a retirement account that we're trying to make last through retirement.
Yeah. And the reality is, when you have historically high inflation like we've had over the last year and a half, that doesn't go away overnight. We're going to have that inflation for the foreseeable future, for at least the next couple of years. When we talk about inflation rates, how the inflation rate's down to 5%, and that sounds good on paper, but in reality, that just means the rate of increase has slowed down. So we're not increasing, the rate of inflation is not increasing as quickly as it was before, but it's still going up.
Right.
We still have inflation. It has not disappeared. Cost of goods and services have not gone down, and that's not slowing down significantly yet. Hopefully it does, knock on wood, right? We all want it to slow down. We want inflation to go away. But it is what it is. This is the economic cycle. We can't choose the period in history where we get, when we get to live. This is the economic cycle that we currently live in, and we have to adjust our portfolios as such. Here's the problem with the 4% rule. If we take that same $1 million portfolio and you're only living off of the income, why did you bother spending why did you bother spending a lifetime saving that $1 million in the first place?
Yep. You're
supposed to go do something with that $1 million. You're supposed to go enjoy retirement. What do you retire for? To go do the things you couldn't do when you were working. To go take the trip, to go on the vacation, to go spend time with your wife, to go spend time with your kids, with your grandkids, whatever it is, I don't care. It doesn't matter. That's up for you to decide. That's your lifestyle. Ultimately, you want to go enjoy retirement, or else why retire in the first place?
How many people, if you asked them, how many clients, how many prospects, how many people just in general, if you went into a room and said, you worked for 40 years and you saved $1 million, how many of you want to pass 100% of your life savings to your kids? Mm-hmm. How many hands would be up in the air?
It's interesting because when I came into this business years ago, I thought that more people would be far more generous to their kids. And it's interesting how many say, not my problem. I paid for college.
Weddings or
I paid for their wedding. I did all the things that I was supposed to as a parent. This is my money to enjoy.
Yeah.
And if there's anything left over, sure, I'd be happy for them to take it. But that's not my goal.
Now, we have clients that want to pass money on to kids, but nobody that I've talked to wants to pass 100% of their entire life savings on to their kids. And if the 4% rule was successful, let's just pretend nothing that we talked about so far today occurred, and you just went through your entire retirement, 20-some years in retirement, and you were just smooth riding on 4% and everything was good. That just ensures that 100% of your life savings, maybe more, is passed on to your kids or your heirs, whoever's inheriting that money.
And how much did you get to really, really enjoy your retirement? Probably not nearly as much as you should have.
Right.
And one thing that's interesting too, I spend far more time with my clients telling them to go spend their money.
Mm-hmm.
And I think most people have this concept or have this idea where advisors are sitting there encouraging their clients not to spend any money because we're greedy and we want to manage everything. And that's just not the case. I spend far more time trying to tell my clients, go take your kids on vacation. Go take the whole family on vacation. I'm meeting with a client next week, as a matter of fact, and they just got back from a family cruise. When I say family, I mean both of their kids and all their grandkids. It was an entire extended family trip that they paid for entirely. I helped set it up earlier in the year when they had to make the down payment. It was a really cool conversation, and I could see how excited they were to do this. I love telling my clients to go spend their money. It's rewarding. That's why you retire in the first place, to go have fun, to go enjoy your life. You're retiring to something. And it's those moments that you're creating, because at the end of the day, when those clients pass away, they're not going to be sweating over an additional $50,000 that they could have inherited by not taking this trip together. They're going to have those memories. Those grandkids are going to have those memories that they created with their grandparents, and they get to have those memories for the rest of their life. And those are far more valuable than a few extra zeros at the end of their inheritance.
Right. And, there's a value here also in when you had that conversation with them. Because of the planning that was done, they can feel good about taking that money. They don't have to, they're not sitting here worried about, oh, I can't take that. I can't spend this money on the vacation because I'm going to run out. Because planning is being done, because these conversations are happening. If you're not doing that, if you're not planning, if you're not taking consideration what your goals are, what your lifestyle needs to be in retirement, what you want it to be, everything should be about what you want it to be in retirement. If you're not planning for that, that's when you're sitting there not spending that money. That's when you're sitting there just, afraid to spend your money, afraid to do other stuff. The planning was what helped those clients feel really good about doing that and doing something that they wanted to do with their money.
Absolutely. So all that to say, the 4% rule has been around for a long time. There's still a lot of advisors like us that utilize it. Well, not like us, we don't utilize it at all, but there are other advisors in the industry that still utilize this. To me now, I think it's a foreign concept, but there's a lot of advisors that utilize the 4% rule when they are constructing retirement income plans, and we think that that's completely, abhorrent, right? I don't think that's we really don't believe that that's the correct way to create a retirement income plan. That's not a way to create a fruitful, sustainable retirement when there are far better ways.
In my opinion, it's a lazy way of creating a retirement income plan.
It is a lazy way of creating a retirement income plan. And all that to say, that's why we created our risk-off retirement income strategy, because we can alleviate the concerns that come along with that 4% rule, and we can do a far better job of sustaining a retirement income that will outlive you, but we're also going to be able to afford you the things that you really get to enjoy in retirement. The extra vacation time, the extra time spent going out to eat. I've got clients that, rent RVs and, they took a big trip out to the West, right? I got other clients that are just foodies. They go out to eat at least 2-3 times a week, even with the cost of
right.
food these days, right? But they still get to do it because that's what they enjoy and they have fun doing it. Whatever that is for you in retirement, we want you to be able to achieve it, and that's where our risk-off retirement strategy comes into play, because it's a far more effective way of ensuring that you don't run out of retirement in your lifetime, but you still get to actually enjoy the things that you enjoy doing. We're taking 10 years worth of retirement income risk off of the table. We are not investing the next 10 to 15 years worth of retirement income that you need. That is not going into the stock market. That's not tied to market risk. So you don't have to sit there and watch your investments every single day worried about whether or not I can go out to eat because the market took a dip this month. You shouldn't go through retirement thinking about that stuff. You should go through retirement looking to enjoy yourself. When you implement a retirement risk-off strategy within your portfolio, you can alleviate all of those concerns. You get to enjoy life to a far greater degree. Well, if anything that we said today hits home with you, or you think any of your loved ones or friends might benefit from anything that we said, please feel free to share our content. If you would like to schedule a risk-off retirement strategy session for yourself or for a loved one, please click the link in the notes, whether you're listening on a podcast platform or if you're watching us on YouTube. You can go to the link at YouTube as well. The same link takes you to our scheduling page, and we will be able to get you on our calendar. We would love to talk to you further about how we can implement a far better strategy than the 4% rule into your retirement income plan. This is Eric Douglas. That's Aaron McAndrew. Thanks for watching.